Hi, John Taylor, investment banker, valuation consultant for small and medium-sized businesses. So, wanted to recap 2017, which was a great year for merger and acquisition activity. So, according to PitchBook data, merger and acquisition value in 2017 was $2.93 trillion. So, this was the fourth consecutive year with where value in the M&A market exceeded 2.9 trillion. M&A within the technology sector represented 17.8% of all transaction value. So, that was an all-time high. So, technology acquisitions are driving a lot of this recent activity. There was also significant European cross-border transaction activity, and just want to talk about, I guess, some of the factors that have led to a strong market in M&A activity over the last year or so. So obviously, the stock market is at an all-time high. Valuations are at an all-time high, and that this is shown in the EBITDA multiples that investors and companies are paying for businesses these days. And of course, Fed easy money policy, which we've had for many years now, interest rates near zero for a long time. This has fueled the availability of debt financing to make these types of acquisitions. So those are all positive things in terms of leading to increased activity overall. And then kind of going forward, I think there's some key points in insight into what's going to be happening in 2018 going forward. So obviously tax reform was huge. So if you look at the OECD average tax rates, these are the largest, most industrialized countries in the world. So the average tax rate was about 24% amongst those companies, and the U.S. was at 39.1 before the tax reform. Now we're at 21% on the corporate side. So that's going to fuel a lot of growth in sort of corporate activity, corporate spending. So GBH Insights is estimating that $300 to $400 billion is going to be repatriated back in the U.S. at a reduced tax rate, and that's going to be spent in the United States. So that's going to be more jobs, more acquisition activity in the United States, more spending on business projects, manufacturing, et cetera. That's going to be very strong. Also, you saw Trump recently put tariffs on solar panels and washing machines in China, 30% tariff. And that immediately led at least one solar panel manufacturer to make plans to begin opening a manufacturing facility. So, that could actually be positive for the economy as well going forward. So, a couple other things I wanted to go through. Obviously, there's been a bunch of factors, strong macroeconomic factors overall driving M&A activity. The IT sector has had very strong volume overall. Business to business dominates the deal value according to PitchBook data. Also, there's a growing sophistication of sellers. This is because there's been a trend going back to the 1980s where there's been a lot of institutional money raised to buy privately owned businesses and sell those companies. So think about private equity firms, hedge funds. There's just been a proliferation of private equity funds as well as funds that have been raised. The size of those funds raised has just been growing and growing for many decades because this is an area that's been very strong because in most cases these companies are purchased with debt, so cheap debt fuels growth in private equity. But so in 2017, 20.9% of all M&A targets were institutionally backed. So again, backed by private equity, backed by hedge funds, other types of institutional capital, and these were sellers. Obviously, about 80% of sellers are entrepreneurial, family-owned businesses. But this shows a growing trend, which will likely continue for many decades going forward. So anyway, I hope this was interesting to you. Thank you very much.